A very good morning, ladies and gentlemen. We welcome you to this session. It's the Q&A session, the most interactive of them all, where we get to answer the questions that you've raised to us, both physically as well as those that have come through online. We are happy to have you here. We're very happy to present what we've done over the past 1 year to you, and we hope it has been satisfactory. With me, I have two very brilliant gentlemen, top-notch leaders. They lead a big chunk of the people that sit at XENO, but they also show us and nurture us on what to do. So I'm very proud to be on this panel with them. Next to me is Mr. John Kamara, the country manager of XENO Uganda. Just for context, thank you. For context, XENO is in Uganda and other countries, so it has different country leads across the countries. So I'm very pleased to be in the midst of country managers. And as I've said, this is Mr. Kamara John. And next to him is Aéko Ongodia, the chairman, the founder of XENO. You'll notice I didn't say XENO Uganda. There's not an error. Of XENO. So very pleased to have you here, gentlemen.
Thank you. Thank you.
Our job is very easy and yet very elaborate. We are here to make sure we break down very many of your investment challenges, answer these questions, and hopefully help to make sure the investment side of life looks like basic English to you. Over and above that, we are here and tasked to ensure that whatever issues, queries, questions that you may have, we are able to respond to them and make sure that you're comfortable. The very first one will go to you, John. What is an AGM? Why does it matter? And what does my vote as a unit trust holder actually change?
Thank you. Thank you, Esther. John Kamara, country manager of XENO Investment, as I was introduced. Thank you for that good question. So an AGM simply is an annual general meeting. So every organization, or most organizations that have public shareholders or public interests or a large number of stakeholders tend to hold an annual event through which they can have the leaders of that association or organization can report back to these groups of stakeholders. So in the case of XENO Investment Management, we have the XENO Unit Trust Funds AGM. So this is an AGM that is for probably 100 or so thousand unit holders in our funds. So this is a mechanism through which we, the fund managers, the trustee, as you saw them here earlier, the auditor, whom you saw earlier, the custodian as well, come and report back to these unit holders. So that is simply what the AGM means. Regards the vote for the AGM, every AGM has particular resolutions that are brought forward to members to make a decision on. In the case of the Unit Trust Fund AGM, like we are here today, we were taking a vote on the approval of the audited accounts for those funds. So that's why it's so important that the auditor comes and gives their opinion, the trustee comes and makes an independent statement on these accounts, and the fund manager can give some context on those numbers and some color on the performance. So that report by all those stakeholders, by all those service providers to the funds was voted on for approval today.
Thank you very much. That is detailed and elaborate. I hope it helps to understand why we're here. Aéko, over to you. This is a very interesting question. What is management's strategy for sustaining growth while protecting unit holder value in the current economic environment? And where does XENO see itself in the next 20 years?
So the first thing that we, maybe just to dovetail off John's answer, is every organization has a governance structure. And so for the entity where our customers, unit holders invest in, it has a similar structure. So at the top, generally, is the regulator. There's a regulator that regulates the industry, our regulator, the CMA, and then there's the governance that essentially ensures that we adhere to the rules of the CMA. That's the Board of Trustees. Our Board of Trustees is KCB, and then there's the operator of the entity. That operator is XENO Investment Management. The name of the entity, by the way, is XENO Unit Trust Scheme. Then, of course, there's the custodian, who is the banker to the entity, and then there's the auditor, who comes and checks, does assurance activities within the fund. And so the strategy within the context of this environment, what is the environment, and how do we deploy our role? So XENO, obviously, besides providing the technology through which the unit holders can create a goal, deposit on the goal, get those deposits invested, and then track the value of that. One of the most fundamental roles that we do is to operate and manage. We are the managers of the investment scheme. And so as managers, we have the fiduciary responsibility to invest our customers' savings as a prudent man would do his own money. And so the way we sort of execute this is to divide the investment options into pure asset class funds. And so we're nearly the only entity that does this. I don't think we will remain like that for a long time. We have a pure asset class funds. Specifically, in this case, we have a money market fund, a bond fund, domestic equity, regional equity. So when somebody's composing a portfolio, they combine these respective funds into a portfolio. And so the first thing that we do when we face with that investment universe is, do we have sufficient coverage of options across the investment universe? And then what is the best combination within the economic environment, but also paying attention to the person's objectives, time horizon, risk tolerance? What's the best combination that allows you to deploy your savings, regardless of what the environment is, in order to chase down your objective while remaining within the constraints that you've set for yourself? And so we fundamentally employ a portfolio philosophy. So for all our investors, the portfolios they hold with us are not invested in a single asset class. It's not just a single money market fund. It's not just a single bond fund. It is a set of those funds. It's some percentage in money markets, some percentage in bonds, some percentage in equities. And even with equities, the Uganda shilling denominated, Kenya shilling denominated. So obviously, the economic environment impacts how the returns in each of those funds evolve over time. And we then, beyond the diversification by providing those asset classes, there's also further diversification within each of the funds. So within the money market fund, there's diversification across the tenors. Same thing for the bond fund, same thing for the equities, across the ticket counters. So there's diversification, first of all, at the fund level, but there's also diversification within the fund to make sure that we are able to collect the underlying yields regardless of where the yields are. And so really, portfolio perspective, but importantly, within those portfolios, within those funds, diversification across.
Thank you very much. You talked about the current economic environment. Yeah. And I have a person here who's asking a very good question. How is XENO handling the impact of rising inflation of fund returns?
Yeah. So, John, I will pass this to you regarding the current inflation in Uganda, how it has been. As the country manager, John, current inflation, and then how we ride that inflation. I think I'll come back with how we ride it.
Okay, so current inflation. I expected that question, and I had an answer to that question recently that was quite good. I asked someone about inflation. What do we do with all this inflation? They told me, you know what, you should spend less. So as one of the measures to curb inflation. However, given we run investment funds, inflation is a key factor that tends to cause a bit of problems in the economy. Now, Uganda's case has been quite fortunate, or has been quite well managed. And as we showed in the fund manager's report, we've had relatively 2 years of stability. Actually, we've had a longer period of stability, but we've had 2 years of inflation below the target, which is 4–5%. Although we may tend to feel inflation here in Uganda, they are, pick any part of Africa and ask how they are doing, and it's much, much tougher. Nonetheless, there is always an expectation that inflation could go higher and tilt the whole balance. So how we tend to maneuver that is what we keep saying, that we like to ensure all our portfolios are diversified. And that diversification speaks to managing some of those risks that we do not have direct control over. So we don't know what inflation will be next year. We don't know what inflation will be 5 years from now. But what we know is that if you have a basket of well-chosen assets, the odds should be in your favor to obtain the best possible return in the environment that we will face at that given time. So that's how we tend to navigate it.
Yeah, maybe I can just add just one line. It's the rationale for investing money really is in order to preserve the purchasing power of that money, essentially in order to keep pace with inflation. If you can do better than inflation, that's even better. Yeah. So we, and I've included, we Ugandans and everyone who is non-Ugandan that invests in Uganda are very lucky to have a country or that has been managed macroeconomically, in the sense that for nearly 2 decades we have had predominantly low single-digit inflation, but also interestingly double-digit risk-free returns, right? You have risk-free instruments, treasury bills and bonds, that consistently over a period of time have provided you 10+. So they give you a cushion above inflation. So the game for us is always to match, most of the time, better inflation. And so the way we've sort of written that and how we respond to it, fortunately, there's a relationship between yield and inflation when it comes to the fixed income instruments, where that tends to get adjusted as inflation moves up and down. Obviously, the inflation that I have personally felt is that at the fuel pump, right? Things used to be 2,000 shillings a liter. I don't know if anyone remembers, but now it's, no one remembers. I remember. It was a while back. But now it's nearly 7,000 shillings, right? So that particular one has been really brutal. But fortunately, we have really fertile soil. We have hardworking people who can till the land. And so when the consumer price index, the CPI, is really a composite of all those. So while it's also a diversified, composite. So when you put all of those, consumer price inflation, consumer price index relatively has been low, but regardless of where it is, the underlying asset classes tend to adjust according to the movement of the underlying inflation level.
Yeah, and Esther, I think the record now is long enough for us to say that all the investors we had from 2017 to date, the history shows that they have outpaced inflation in terms of their investment returns. Yeah. So I think the past has been good to us. We hope the future will be better.
Yeah.
Amen.
And I think, Esther, if you can, the last thing you can answer that question on a graph. So if you plot the inflation level, average inflation level across the years, and then the average returns across all of our funds, you will find, or across the moderate portfolio. You pick a moderate portfolio in any given year, and then you plot that. That gives you a sense of what the return has been relative to the inflation and how that adjusts over time.
Thank you very much, gentlemen. That was very detailed and very insightful. Speaking of that, a question for you, John.
Yeah.
You presented results across the different funds. Is it safe to say that those results are decent above inflation for every client?
Absolutely, is the short answer.
So the clients should be happy, is what you're saying?
Very happy. I mean, all the returns are seated above, high teens to all the way to 40%. So really, for anyone who has been invested over that period of time, and we also labored to show some of those returns on a 3-year rolling basis, a 5-year rolling basis, clearly the record shows that they should have been ahead of inflation. But the short answer is yes. Do you want to give the long answer?
No.
You're not free yet.
Yeah, but maybe just an addition is, I think what I emphasized during the keynote is a habit. Yeah. The key takeaway is sometimes we get into this business and we say, now is not the right time, now is not the wrong time, etc. So many times it's just invest. Just think about the price of 1 acre of land in Kololo in 1986, right? If you had started picking it up then, picking up 1 acre, we would own the entire hill, but we didn't, right? And so just pick any hill anywhere, and this hill is the XENO Unit Trust Fund. Just keep picking each of those units. You might, if you do it long enough, you might own the entire fund and therefore own the entire underlying.
Thank you. Follow-up question.
Yes.
I told you you're not yet off the hook on this one. The returns were very exciting, especially those from the equity funds. Yeah. Is it possible to have a 100% equity portfolio? That's part A of the question. Part B, how do you determine the client's investment strategies?
Okay, very good question. So, no, it is not possible to be invested in one single fund. And I think this is something we've been consistent about and have repeated several times. So this simply comes from the fact that we are trying to manage these investments as prudently as we see fit. Now, prudence sometimes causes you to earn a return that is lower than what's possible, but it also gives you the safeguard to earn a return that is higher than you would have when there is economic chaos. So that is why we take that approach and ensure that all our portfolios we manage are well diversified. So we have anyone who's familiar with financial history, you will see so many episodes decade after decade where a particular asset class or particular investments do not meet their expected returns. And that always happens from, again, ironically, the high expectations that those asset classes are going to deliver returns. So we've tried to stay away from that and ensure that we diversify for all our clients. Now, part B is how do we do that diversification? So we've also, I think, been very good at doing this because we have made very good use of technology and we've automated this process. So the process is simply one that takes you through a diagnosis to determine what your goal is, what your risk appetite is, how long you need to achieve this goal, how much you plan to save for this goal, and all those factors come together in a kitchen, and they bring out for you a portfolio that's constructed, which we call an allocation, so a portfolio allocation. So that's what that process generates. It is very objective. It is based on data. So myself or some of the team members you saw do not imagine up these things. So it is done very objectively, and a portfolio allocation is given to every particular goal that an investor has. So what that means is that a unit holder or an investor could have 5 different goals, and they have 5 different allocations, and they experience 5 different return series over a period of time. Yeah.
Thank you very much. That's in English, you're basically trying to say you ask me questions. Based on how I respond to the questions,
yes,
you then generate an investment strategy that best suits me.
Correct.
So is it true that each investor is unique from the other?
Absolutely, and every goal is unique from the other.
Okay.
You've said it well. Maybe you should sit here, and I switch there.
Okay, thank you very much, sir. Over to you, Aéko. I have a very interesting question for you here. What are XENO's plans to expand across the continent?
I did not expect this one. So our perspective is we are in the business of helping form habits. Habits are along a person's objectives, what are they chasing, and then building the workflows to be able to chase down those objectives. And then building the enablement to build the habit to chase down that objective. So right now we're in Uganda, we and Kenya. We were supposed to get up and running in Nigeria, but a few regulatory changes happened there that made it suboptimal for us to enter at that point. But there's a couple of markets that we're looking at, but we're not looking at, and this informs our strategy. We're not looking at those markets for the sake of expanding necessarily. In evaluating every market is, does this problem that Ugandans face, Kenyans face, exist in such a market? And what is the problem? That people want a structured way to move some of their money into the future, right? To solve a future financial goal. Is that a common thing? Like Zambians, I don't know if they eat maize. Do they also, while they're eating maize, have such a problem of moving some of their money into the future? How many of them are there? How many times do they face, how frequently do they face the need, do they need to move that money to the future? And can we, does the regulatory environment support this? Fortunately for us in the industry, so many countries support that, and these problems exist across, and so this is something that we're doing. So we are very long on the continent. We think we can not only encourage the habit formation here, we can encourage that habit formation across so many geographies.
Okay, thank you very much, Aéko. I would like to give you this question as well.
Okay.
Hopefully you answer it on behalf of your younger self. How does XENO plan to attract younger investors, and what is that problem that it intends to solve for them?
Yeah, some of the audience knows that the first time I got an investment account, I had to get onto a bus and travel to Nairobi to set up an investment account. I got onto an overnight bus. It was 2005. There's only two people in the audience that I knew in 2005. All of them have lost their hair. But
look around.
Yeah. And I was a young man, but even before that, there's again 2 people, 3 on the audience that know that I was very much interested in in the financial services, specifically investing as early as the year 2000, 2001, and started reading up. But I didn't have a way to act on that interest. I didn't have a way to invest that little money that I had, that 5,000 shillings that I had. So, and in building XENO, this is not only built for boomers like John, we've also been able to think very deeply around it and say, okay, if a person has a family, yep, can they create an investment account for their child, right? Can they seed it with some money? And so we created this wonderful envelope called the XENO family account, where a family member sets up, a family member who can read, who can write, and is a good citizen, has a national ID, and hasn't gotten proceeds, hasn't gotten their money from crime. So basically, ticks off the KYC. Sets up the account, and then can set up sub-accounts under that family account for each of their family members as young as 9 months old, right? But they essentially, that we call it the family account. You can set up an account for each of those children, and within those different accounts, set up several goals for each of those children. So young people as young as 9 months old, but if they are old enough and have a national ID and can read, then they gain access to be able to view their individual accounts. Of course, if they don't have a national ID and can't read, they can't gain access to it. Yeah? But so that's one way we're thinking of encouraging much younger people. But let me assume the person that asked that, it's a bad assumption, they're at university or they're in high school. How can they, if they have some 10,000 shillings to spare, how can they begin interacting with a sequence that helps you form a habit? Imagine you are able to have access to an account that helps you form a habit when you're in high school. You would be a completely different person. So we've thought about that sort of person, and we've encouraged them to get in touch. We possibly will think through, we've already thought through it, we haven't yet launched it, but an ambassador program for kids in high school, for kids in university, to be able to start acting on this and see how that habit actually drives value and changes lives.
Awesome, very awesome.
Yeah.
And I hope that gives hope for the people that are young, so they can start early, start small, but start consistent.
Yeah.
John, over to you. Again, you presented returns. They were amazing.
Yeah.
They were in UGX.
Yeah.
A client is asking, do you have plans to launch a USD fund?
That's a great question, and it's ironic. It's something we've been working out behind the scenes, and what the considerations for us are, which kind of asset classes should we be able to provide as exposure to our investors. But also, more importantly, we want to make sure we do it in a way that's consistent with our philosophy. So we don't want to just throw foreign denominated assets on investors here for the sake of saying we have foreign denominated assets, but we want to do it in a way that it can align with the philosophy and allow customers who have shillings or other denominated currencies to be able to obtain exposure that comes from that asset class. So the way we look at it internally is we would like to add additional exposure on the current portfolios we have that we hope would optimize the portfolios better or make the portfolios withstand stronger storms. So that is really how we look at it. But the short is, yes, we are cooking something.
Oh,
yeah.
Very good. We are excited to see what you're cooking. I have questions here regarding your product.
Okay.
I am going to request that you both take them on behalf of my colleague, who does not seem to be here at this stage. Do you have any exciting products to launch this year?
Start with you.
Over to you, John.
John.
Okay, so products to launch. Of course, you know, when things are in the kitchen, you have to go slow with announcing them before they are ready. Obviously, we run a regulated service or product, so some of the things we are working on have to go through standard regulatory hurdles. However, what is the latest on our radar has been yet another way we've allowed our customers or investors to be able to create the habit. Our chairman talked about the habit of continuously saving. So we had done this previously with mobile money, and now we've also taken this to bank, and we've been able to work this out with one particular bank so far, that's Stanbic Bank Uganda, and it allows that habit to be automated, to be formed, and we've seen that's a huge, huge lever in terms of taking investors to their desired financial outcomes. So that is a bit of a sneak peek.
Yeah, we are also, besides the USD funds, which John is cooking up, as well as automating deposits from banks, from any bank as well. We exist in a world where technology is moved, and we potentially, we've already begun experimenting. There's a bunch of experiments we're running behind the scenes, but incorporating new technologies such as AI in our advisory process. And so this is something that is really big. Over the next 12 months, you're going to begin realizing a few things that you have access to, building into the workflow potentially. By the time we have this conversation 12 months from now, we might be a completely different company, and you might have a completely different experience from the one you are having right now.
We're very excited to have that. Ladies and gentlemen, we are having the question and answer session. And if we have any questions in the audience, feel free to
Write it down.
Put up your hands. We'll choose one or two people to ask the questions before we get back to the questions that are coming in online.
Thank you, Esther. My name is Richard Sechtoreko. I've been an investor with XENO for the last 5 years. Thank you. I have two questions. One, the fund managers clearly told us that they execute each investor's strategy using 4 funds. However, from the side of the investor, we know that we have only one collection account with Stanbic Bank. So I would love to be educated. Where are these 4 funds physically located? That's the first question. Then the second question, the fund manager has also presented to us a very exceptional performance for the year 2025. But as an investor, I would like to understand, how does that translate into returns for me as an investor? Using an example, if my risk profile is, say, 1, at level 1, what would that translate into? Because the fund managers told us the yield for the XENO Uganda Money Market Fund was 13.37. XENO Uganda Bond Fund was 16.5. And Domestic Equities Fund, 34.5. And Regional Equities Fund, 45. So how would that translate now to the side of the investor? If the investor's risk profile is set 10, which is the maximum possible, what would be that investor's return? Thank you.
Okay. Thank you very much, Richard. I beg that we take those, and then we will take the rest.
Yeah.
The first one, where are the funds physically located? We have only one collection account, which is a custody account.
Yeah.
That's the first question, and then I'll give the other to Aéko.
Okay, so thank you, Mr. Sechtoreko. So the 4 funds we manage are all under Stanbic Bank custody. So each of those funds maintains a bank account with Stanbic Bank. Now, what we have for the ease of how we construct portfolios for you is we have all those funds in a collection account, and then from the collection account, those funds are distributed across the 4 funds depending on the specific allocation of your portfolio. Just like, as you mentioned, 1 out of 10 or 10 out of 10 risk tolerance, you would have different amounts of money going to the different funds. So that is how we set it up. So we think it's easier that way for you to simply have one collection account, because it would be quite difficult if someone was to deposit 10,000 and they had to split it and send 2,500 to the money market fund, 6,800 to the bond fund, and then the balance. It would be quite inconvenient and costly.
Maybe just to add there is, so that goal that you're chasing, when you deposit it, we ask you those set of questions, but it's really a trick. The trick is to get an instruction from you once. Every time you deposit, which funds should we, where should we invest your money? That's technically it. Yep. Those questions are asked, where should we invest your money? So where we should invest your money is based on the set of information that you've given us. That set of information says you have a risk tolerance 1. That means 25% money markets, 75% bonds, for example. Or where should we invest your money? You answer the questions and you have a risk tolerance 10 out of 10. It means, say, 5% money markets, 50% bonds, and then the rest of the 45% in domestic equities, regional equity. So that is an instruction. So every time you deposit, whether it's 10,000 shillings or 10 million shillings, we already have the instruction as to where that money should go. Every time it goes into the collections account, there's automated workflows that divide it across the 4 different funds.
Thank you very much. Do we have any other questions from the audience?
I think there was a second question.
No, there were 2. He has answered it. He has talked about the 1 out of 10 and the 10 out of 10.
There was a third one.
He asked about the translation of the returns.
Oh, returns,
yes.
How do the returns translate to his approach?
Yes.
Yes.
Do you want to kick it off?
1 out of 10?
Up to 10 out of 10.
10 out of 10.
Yeah. So I'll give a stab at that one. So from 1 out of 10 is a portfolio that includes maybe the most conservative combination of assets. So conservative in this particular case is referring to assets that have the least amount of volatility and the least chance of a change in your invested value or your principal value. And then all the way to 10 out of 10, which would include assets that are called risky academically, but they are simply more volatile. They can move much higher and they can move much lower. So statistically, the distribution of the returns is much wider. So meaning in a year you can have 45% like we did last year, and in another year you could have 2%. Now, how that translates, it is not easy to show that without specific numbers to work out the translation. However, there are 2 things that could cause differences between the return of the fund and the return on your portfolio. So one, of course, is the allocation. That is standard. Maybe I'm invested more in the bond fund than Esther is. If the bond fund does well, Esther's portfolio does better than mine. That's standard. Then the second item is the cost that you bear to be invested in this fund. So these funds have a number of costs to run, and the returns that typically are displayed as yields are gross returns. So after those fees comes to a net return. And then lastly, and very tricky, is the timing of your deposits and withdrawals into those portfolios. Now, that's where the math gets a bit complicated. My boss will go through the math. But as you invest, deposit, and withdraw, the timing of that deposit could have come at either a time when a fund was just about to achieve a higher return or a lower return. And that ends up affecting a return. But of course, we are available 24/7. We can go through a detailed return profile for any of your goals.
Maybe now that he's here physically,
Yes.
one of the advisors could do the honors of taking him through a detailed advisory session.
Absolutely.
So that he knows exactly what his investment strategy means in terms of return.
Yeah.
But if I may, I just want to add just one little detail, and it's just expounding on what John has. So let's say December 20th, first of all, fantastic. 5 years, you should have a medal. we recognize you. Thank you so much for trusting us for 5 years. But now, let's just play December 2025, 31st December. Let's say you had $1 million shillings. I am sure if you've done this for 5 years, you'll have more than $1 million shillings. But let's just assume you have $1 million shillings. And then life happens. You don't invest the subsequent months. Let's use December 2024 actually. December 31st, 2024. You had $1 million shillings. And then you don't add any more money in your portfolio.
And don't withdraw.
And then don't touch it. That bad habit. There's a good habit and a bad habit. Don't touch it, right? And so your money market yield for the number of units you had that add up to 1 million shillings, right? In December, you possibly maybe had 100,000 in the money market fund, 600,000 in the bond fund, 100,000 in the domestic equity fund, and 200,000 in the regional equity fund, all added up to 1 million shillings, right? And so at 31st December 2024, you don't do anything for the entire 2025. Those allocations will perform at the presented, from that time period on to the end of December 2025 for the next 12 months. However, that is not real life. That is a really weird person that does that. Yeah? Many times you earn a salary in January 2025, you deposit some money, right? On the 14th. Then in February, you miss depositing because you forgot. You instead make a deposit on the 3rd of March and then on the 28th of March, for example. So the amount, the performance for each of those deposits is going to vary a little bit from where the other ones started because of the time horizon, but also the timing of the deposit into the funds. So those are the sorts of things that will, but what we emphasize is the average returns on those portfolios will be the same. It's at what time did you pick it up? For example, if the money market fund performed at 13%, but you invested in June, right? While the annualized return you will get is 13%, but the actual return, because you only did 6 months, will be about half of that. So that's sort of how to get this.
This is very interesting. I have it's not a question per se, online. Just to attach to this one before we continue. She's called Dorothy.
Dorothy.
Yes, she retired in 2020 and deposited 30 million onto her XENO account. Invested very conservatively and forgot about it. So her money doubled by the beginning of this year. And her question was, how did that happen?
So, I've put up my hand before I was given permission.
You don't have the permission.
No, my only comment to Dorothy is congratulations.
Congratulations. Yeah, so Dorothy is like my primary school headmistress.
Yeah.
So this is the trick that we use internally. General advice is if you get an asset that gives you double-digit returns. What's double-digit returns? At least 10%. If you get an asset that gives you at least 10%, don't let it go. Yeah? It's a fantastic, because you've got a compounding engine. Think of it as a compounding engine. For an asset that gives you 10% return annually, and you ride that over the next several years, how long will it take to double? Normally, it will be the rough math. Esther is a mathematician. The rough math is about 7 years, right? It takes about 7 years. If that asset earns a bit more than 10%, it will take a shorter time, maybe 6.5. If it earns considerably more than 10.5 or 12%, you get closer to 5 years. So 2020, this is 2026, and it has already doubled. More than likely, Dorothy's portfolio worked at higher than 10%. And that there, ladies and gentlemen, is Exhibit 2. Exhibit 1 was my former headmistress, Mrs. Muzuri.
Thank you very much.
That's the power of compounding.
Thank you. And after here, we request that Richard, you stay around. We will have an advisory session for you so that you can have detailed responses to that.
Yep.
Thank you. Next question.
Yes, good morning. Thanks for the good numbers. My name is Ali Twaha, and I work with New Vision. But I'm also a member of XENO since
Very good.
since 2021.
Wow.
Yes. My question is on your view, the founder, in regard to alternatives that are out there. You've mentioned quite a few in the past, but I've not seen action on some of the things you have mentioned. I'm asking this because for a member who has maybe been there for a while, let me use myself as an example. You accumulate some money, but then you feel the 11 or the 15% is maybe not enough for your goal in mind. Do you think the alternatives that are out there are not doing enough? Okay, are they not interesting you for a member who's looking at a rate of maybe more than the 20-year bond or even the 10-year bond? Just your view around that. Thank you.
Just before that, his question is related, so let's take it as well.
By chance, my question is related to his. It is, XENO Uganda is in the money industry. We know this is a very competitive space. Can you throw more light into how XENO is performing in it? Why would one choose you? Thank you.
Thank you.
My name is Makayo Korea, one of the unit holders.
Have you not involved?
Yes.
I proceed?
All right. We're going with the third one?
One more? Okay, I'm not a member, but I want to become a member.
Oh, thank you. Thank you.
We spoke earlier. My name is Ismail Adu, a journalist with Nation Media Group. So I'm just trying to understand you two as human beings, and using your own words and as briefly as you can, how do you deal in a situation when things are not moving your way? It's a bad day in office. How do you go about it? And when things are really good, the portfolio, everything is growing, how do you also respond and react to that? Do you believe that you've done it on your own? Are you the guy who pats, your staff at their back and say, job well done? Just very briefly, I'm just trying to understand you two as a human being using your own words.
Okay.
Thank you very much. I'm going to be very happy to ask those questions again, especially the third. But I'll go to the first. What's your view of alternative investment strategies in terms of higher returns or accruing higher returns as compared to what the funds?
Yeah, thank you very much. Like that. So our view of investment is simply the underlying assets are just tools that we use to pursue our objectives, right? And so we start with what is the underlying investment universe, right? that is allowable, that is regulated, and that we can compose, right, in a meaningful way, and then pipe up to our investors, right? And so I'd like to say a wrong thing. This is the wrong thing, that the bond market is in any jurisdiction, is the largest asset class. Bonds, fixed income is the largest asset class in any jurisdiction. It's the largest in Uganda, largest in Kenya, largest in the US. It's not the US, it's not the stock market. But that's actually the wrong statistic. The largest asset class is real estate. It is everywhere. We are seated in it. It is, you go out, you touch it, there is actual land available. But it's a very difficult, in some cases, intractable thing to package and then to pipe up because of its characteristics, its nature. Yeah? And so what we do then is to zoom out of the individual asset classes. Our objective is not to give you specific asset classes. Our objective is, what do you want to achieve of what is available and can easily be packaged up? What of these things can allow you to arrive at your goal? And then we package those things up transparently in order to allow you to achieve that. And so while the universe of asset classes that we have, and we've taken care to define them as pure asset class. We have a money market fund, short-term debt instruments. We have a bond fund, medium to long-term debt instruments. We have a domestic equity fund, listed entities in Uganda. We have a regional equities fund, listed entities within the region. Those are things that we can easily read. I think John is cooking up to expand the investment universe. But regardless of what is, it will always be things that we can package and whose pricing is regulated in some sense, and they can be transparently packaged up to the investor. And so that's sort of what informs what are these things that we use to compose our portfolios that can help our clients reach their objectives, and they are reasonably regulated. And so right now within Uganda, for example, we don't have a regulated real estate investment trust. They exist in Kenya, but they have all sorts of problems, right? Like real estate is really difficult. And for the yield advantage that you're chasing, you realize they don't give you, at least on the ones that have been traded and are available to people, don't give you any significant yield advantage. The data is there. There's no significant yield advantage. If they're difficult and no significant yield advantage, then why do you do them? And so we leave others for now to do them. For now, we are just taking regulated assets that can easily be composed into portfolios.
Maybe just to add to that for clarity, the funds that you have today, do they have specific purposes that you're trying to achieve for the customer?
Yes. So each fund, by the way, each asset class is pure asset class, but there's a reason it is composed. Money market is relatively liquid instruments that you can easily liquidate if you have a need to withdraw some of that money, for example, right? Bond gives similar structure, slightly longer term. You can't easily liquidate them as you can liquidate the ones in the money market, and therefore there's a little bit of a risk there. But they give you slightly higher yield advantage, similar structure but higher yield advantage than you'll find in the money market. And then domestic equities give you drivers of growth within the Ugandan economy. So obviously, people spend money, people buy airtime, people pay fees to banks. Why don't we own them instead of paying all these account management fees to them, pay interest for taking loans, etc. So what we do is to compose a portfolio that can own some of these banks, can own some of these entities that generate revenue within the market. And then we go across East Africa. So the difference between domestic equity and regional equity funds is there's an FX exposure, but also the underlying drivers of returns are outside of this border. So you get a diversification again around the market. So each of them is composed in order to give you exposure to different drivers of returns. That's essentially how we think about it.
Thank you very much. John, how is XENO performing competitively against the rest in this market?
Okay. Yeah?
Yes, that's the second one.
Second? Okay. Yeah, so how are we performing against the other players in the market?
Yes.
Is that correct? Yeah, so I think the information is all publicly available now. There's an obligation, I think, with every investment manager to declare their performance, but there's a bit of a caveat with that performance you see, because it may not be specifically verified by an independent third party. So just like we've presented here, our audited accounts and our investment performance, that is how we've computed it and what we've presented to unit holders. But I really hope I won't be quoted much on this, but
You will be quoted.
I will be quoted. Okay, nonetheless.
It's a public forum.
Yeah, so nonetheless, I think our equity strategies in particular have done much better than the market. Both the general stock market and other funds, at least I have observed in the market. But importantly to note is that the particular strategies we deploy in investing those funds. So what we are simply trying to do is capture the entirety, to the extent we can, of returns in that asset class. So if there is an asset class here of equities or stocks, we try to capture that return and deliver it to you, the unit holder. Now, what we do not do is try to do other investment activities outside that to presumably capture more return for you or less return, as it may turn out. So we are trying to give you what would be called the market return or the average return. So if the market was to move upwards, your performance and our investment funds should move in tandem. If it moves down, so should it move in tandem. So we don't have factors outside the market, aside from a few things, but they are not significant, that affect the performance that we report. So I think we've done average or slightly better than average due to a few things that were able to go our way. But our expectation and our objective is to do the market return.
Thank you very much.
Yep.
The gentleman from Monitor asked a question to each of you. It's personal. How do you deal with best and worst case scenarios? John, over to you first, and then you'll hand over to Aéko. Do you fire the bosses, worst case, the employees? Do you give them bonus?
Okay, I think, I introduced the team members, they're around, so you can also pick, pick a more objective opinion from them. However, good times, we've experienced good times. Our funds have performed well. We've had good growth that we didn't anticipate would come across many years ago. We've had huge number of unit holders trust us and use the product. So those have been huge wins we have made. How least I tend to handle them is to look at the next task we have to do. So we've performed well this year, but there are things that I can do or that we should be doing that will help us perform better next year. So that's where I tend to focus my time. Now, in the bad times, I will remember these good times and say they were good times, so bad times, these bad times will pass, and so I shall be fine, and we try to remain calm. Yeah.
Over to you, Aéko.
Yeah, so the one thing I can say is this company and this movement has not been built by one person or two or three. It is a collection of brilliant young men, brilliant young women, some young, some old. But all of them are arranging themselves to do what is best by the customer. And this, whatever their work is, doesn't count if it does not deliver to the customer. So essentially then this company has been built by our clients, by our investors, by those builders, those visionaries that are staking something today in order to shape and build tomorrow. This very building we're in was somebody's vision at some point. If it wasn't for that person who fought tooth and nail, and many times you have to fight tooth and nail, we wouldn't be seated here, we would. And so this is a nod, first of all, to the young men and women, old men too, and women that have built it, but most of all, it is an ode to our customers who have made it all possible.
Thank you very much. I happen to be one of the people that are being led by these two gentlemen, so I want to give an independent response to that question. I feel like I'm the only objective one to that question here. These gentlemen have taught us to follow the process. The good times we celebrate, the bad times we learn. What's important, we follow due process. We'll take one more question, and then we'll close the session, ladies and gentlemen. Any questions from the audience as we close? Maybe the two? In summary? Okay. Just two questions, and then we close the session in the interest of time.
Thank you. My name is Innocent Damlira. I started building XENO in 2022. Not as a founder, but as a member. I am very excited by the performance of domestic equities and the regional equities. So my question is, over the years, analysts have told us that equities have been struggling, really struggling. So based on that information, me and several others people constructed a risk profile that is very rigid. And therefore, for that reason, I could be getting not very good returns from, I may not be taking a significant benefit from the very good performance of the regional and local equities. From your analysis of the next year, should I touch my risk profile and take more risk based on the performance that I have just seen here today? Or I should remain conservative? Thank you.
One more question, and then we'll take them together and close the session.
Name is Hamna Makajo, speaking as a member since 2019.
Oh.
Just wanted to understand, do we as members benefit from, would we as members benefit from exposure beyond East Africa? I know you have equities and bonds and all that within East Africa. How about the rest of the continent, South Africa, even New York and all that? Is there a benefit from us? Are the returns there less than we are getting? How are you guys as management thinking about that? And is that on the roadmap in any way?
Thank you very much. So we're going to take these two questions and we'll close. I request that you take the first one, John, and then Aéko will answer the second one.
Okay.
I'll hand back to the chairman of the AGM.
Okay, thank you, Innocent. Congratulations since 2022, not as founder of the institution, but of your portfolio. Yeah, so what we would advise you to do, and we advise other unit holders, is to think about that problem in form of the different goals you might have. So we have the advantage, me, you know, everyone else in the room, to be able to have two different portfolios. So we are fortunate that there is no gun to our head that says I must only invest in one specific portfolio. So what that does is it guides the discussion on where the risk tolerance should lie or where your aggressiveness should lie. So there could be particular things or particular goals you have that you would not want to subject to any potential volatility or unseen risks. And then there are other goals you could have that could be very aspirational and long-term. You want to retire in 20 years' time, you want to start a business 9 years from now, you want to aggressively accumulate funds in your portfolio. So that way it avoids you from being in the corner or the dilemma you're in by thinking you might have to either take this option A or option B. And if you take option A, there's no option B. If you take option B, there's no option A. So I would really advise that we can look into your circumstances and your particular financial goals, and we can construct maybe 2 or 3 that fit different purposes, and then one could potentially have exposure to some of these other assets that in good years could have such returns, but maybe may not have other years as brilliant as those. Yeah, that's how I respond to that.
Thank you very much. Aéko, would you respond to the question regarding other exposures outside East Africa?
Oh, yes, yeah. So we always are looking to sort of expand the available investable universe. Yeah? And so exposing it to different countries, different drivers of return elsewhere than here is wonderful. So it is within our roadmap to expand the number of funds and also the currency of the funds within here. So that's the short answer. But when we're deciding is essentially once that becomes available, it is important, even before it becomes available, to sort of review your investment strategy annually. I think that is generally, and then update it accordingly, even your thinking on your circumstances. But there's even something slightly better than that, which is what John has said. Have under your profile, under your account, have at least 3 separate goals. Have a short-term one, for example, an emergency fund. Have a medium-term one, for example, buying a home or building a home. And then have a long-term one, for example. And so most of the time, the risk tolerance and therefore the underlying portfolio will be holding different fractions of the underlying. And so that's how sort of you get that exposure. It depends on what it is, but usually we give, if I was designing this again, I would suggest at a minimum, each person has 3 goals. Of course, it depends on, can you actually fund 3 goals reasonably? 3 goals, there's a short-term one, there's a medium-term one, and then there's a long-term one. And then you begin working on them based on how your financial situation is. Thank you.
Thank you very much, gentlemen.
Thank you.
It's been an honor to have this conversation. Thank you for answering those questions in detail. Thank you to you, the audience, for the great questions you've asked. They've been very engaging, and I hope that they've been very insightful, the responses that we've got. Thank you very much. Back to you, the chair of the AGM.
Thank you.